On Monday, January 20th, 2026, the yield on Japan's 40-year government bond exploded to 4.24%, breaching the 4% threshold for the first time in over 3 decades and marking the highest level since the bond's inception in 1999. By Tuesday, the 30-year yield had spiked 30 basis points in a single day and 42 basis points over 2 days to 3.91%. The 10-year Japanese government bond yield surged to 2.38%, levels not seen since 1999, while 20-year yields jumped 22 basis points in one session to 3.48%. This wasn't a correction or a temporary sell-off. This was a bond market rebellion, a vigilante uprising against fiscal irresponsibility, and the opening act of what may become the most consequential unwinding of global capital flows since the Plaza Accord. I'm not a financial advisor. This isn't financial advice. This is an educational analysis based on publicly available information and historical precedent. The $1.1 trillion question isn't whether Japan's bond meltdown matters to American retirement accounts. It's whether anyone managing those retirement accounts understands that the entire architecture of post-financial crisis asset prices was built on the foundation of Japanese capital flows that are now reversing, and that when those flows complete their reversal, the repricing of global risk assets will destroy wealth on a scale that makes previous bear markets look like rounding errors. The catalyst for Japan's bond market rebellion was Prime Minister Sanae Takaichi's announcement on January 19th of a 21.3 trillion yen stimulus package she's calling Saneonomics. Less than 3 months into office after winning election in October 2025 on a platform of responsible, proactive fiscal policy, Takaichi dissolved parliament and called snap elections for February 8th to secure a mandate for her agenda, which includes a 2-year suspension of the 8% consumption tax on food and massive infrastructure spending. For a country with a debt-to-GDP ratio exceeding 260%, the worst in the developed world, and credit ratings from Fitch, S&P, and Moody's that are 4 to 5 notches below AAA, announcing unfunded stimulus while inflation runs at 3%, and the Bank of Japan is trying to normalize monetary policy after decades of zero and negative interest rates represented a declaration of war against bond market discipline. The market's response was immediate and merciless. Investors began dumping long-dated Japanese government bonds in volumes reminiscent of the UK's September 2022 mini-budget crisis that destroyed Liz Truss's government in 44 days. What makes this structurally significant rather than just another emerging market-style bond tantrum is that Japan is not an emerging market. Japan is the world's 3rd largest economy, the 2nd largest sovereign bond market, the largest creditor nation on earth, and for the past generation has been the primary source of cheap capital fueling global asset prices through the mechanism known as the yen carry trade. That carry trade, estimated conservatively at $4 trillion and aggressively at $20 trillion when including government pension funds, the Bank of Japan's holdings, and state-owned banks, operates on an elementary principle. Borrow at Japan's near-zero interest rates, convert yen into dollars or euros, invest in higher-yielding assets like U.S. treasuries, equities, real estate, or crypto, and pocket the spread. As long as Japanese rates stayed near zero and the yen remained weak or stable, this trade generated essentially free returns leveraged across the global financial system. But when Japanese yields rise dramatically and the yen strengthens, the entire structure unwinds violently as investors must sell foreign assets, buy back yen to repay loans, and accept losses on positions that were profitable days earlier. The mathematics of the current situation are creating conditions for unwinding that dwarf the August 2024 carry trade panic that crashed Japan's Nikkei 12.4% in a single day, its worst performance since 1987. At that time, the interest rate differential between U.S. 2-year treasuries and Japanese equivalents was 450 basis points. Today, it's 320 basis points, and narrowing rapidly as Japanese yields surge, while U.S. yields hold relatively steady. More critically, the August unwind was triggered by a surprise Bank of Japan rate hike that caught leveraged traders off guard, but occurred in an environment where Japanese fiscal policy remained broadly restrained. The current crisis combines the worst of both dynamics: aggressive monetary tightening as the BOJ raised rates to 0.75% in December, the highest since 1995, while simultaneously the government abandons fiscal restraint for the largest stimulus package in years. This pincer movement between hawkish monetary policy and loose fiscal policy creates the exact conditions that historically produce sovereign debt crises in developed markets. The human institutions caught in this vice are Japan's massive life insurance companies and pension funds, which collectively manage trillions in assets and have been among the largest foreign holders of U.S. Treasuries for decades. Giants like Dai-ichi Life Holdings and Nippon Life are reporting unrealized losses on their domestic JGB portfolios, estimated at $60 billion as of early 2026. These institutions face what's called a mismatch risk trap. They sold insurance policies and pension products to Japanese households decades ago when interest rates were near zero, promising returns based on those low-rate assumptions. They invested premiums in JGBs yielding zero or negative rates because that was the only domestic option available. Now that Japanese yields have spiked to 4% on the long end, they face capital requirements on legacy low-yield portfolios that are becoming impossible to meet, while simultaneously seeing attractive 4% yields available on new JGB purchases. The rational response is to liquidate foreign holdings, particularly U.S. and European debt, to cover domestic obligations and reinvest in now attractive Japanese bonds. This repatriation has already begun and is accelerating as the yield differential narrows. The scale of potential capital repatriation is extraordinary because Japanese investors are the largest foreign holders of U.S. Treasury securities, holding over $1 trillion at last count. For decades, this capital flow acted as a ceiling on American borrowing costs, providing reliable demand for U.S. government debt that allowed the United States to run persistent budget deficits without triggering bond market discipline. When Japanese institutions were earning near zero at home, buying U.S. Treasuries yielding 2, 3, or 4% made sense even after hedging currency risk. But the mathematics have inverted catastrophically. A Japanese investor buying a 10-year U.S. Treasury today and hedging currency risk back to yen would earn negative 1.57%, obviously far worse than the 2.38% available on domestic 10-year JGBs. The carry has not just diminished, it's reversed completely. Continuing to hold U.S. Treasuries under these conditions isn't conservative portfolio management, it's value destruction. Every basis point Japanese yields rise relative to U.S. yields makes the case for repatriation more compelling and the case for maintaining U.S. holdings less defensible. The timing of this reversal could not be worse for the United States fiscal position. The federal government is running annual budget deficits approaching $2 trillion, requiring massive ongoing issuance of new Treasury securities to fund operations. The Congressional Budget Office projects deficits remaining elevated throughout the decade as mandatory spending on Social Security, Medicare, and Medicaid grows, while interest payments on existing debt consume an increasing share of the budget. The government depends on reliable demand from foreign buyers, domestic institutions, and the Federal Reserve to absorb this supply without yields spiking to levels that would make the debt unsustainable. Losing one of the three largest sources of demand, Japanese investors, while supply is surging, represents a textbook setup for a sovereign debt crisis, where the government can only sell bonds by offering yields high enough to crowd out private investment and potentially trigger recession. The cascade mechanisms are already visible in real-time price action. On January 20th and 21st, as Japanese yields spiked, U.S. Treasury yields followed, with the 30-year Treasury jumping 9 basis points to approach the critical 5% threshold and the 10-year adding 6 to 7 basis points. UK gilt yields, French OATs, German bunds, all sold off in sympathy as global bond markets repriced for a world where Japanese capital is no longer available to suppress yields. The pattern repeats the dynamics visible in previous episodes of carry trade unwinding. In March 2020, when the COVID crisis triggered a dollar funding squeeze, foreign sellers dumped U.S. Treasuries to raise cash, causing yields to spike before the Federal Reserve intervened with unlimited quantitative easing. In August 2024, the surprise BOJ rate hike triggered violent deleveraging that crashed global equities before stabilizing when it became clear the central bank wasn't going to continue aggressive tightening. The critical difference this time is that previous unwinds were triggered by temporary shocks that reversed once central banks provided liquidity or policy guidance. The current unwind is being driven by structural changes in relative yields that won't reverse quickly. Japanese fiscal policy under Takaichi is explicitly abandoning the austerity that kept debt levels stable, even as they grew relative to GDP. The Bank of Japan is committed to normalizing policy after decades of extraordinary accommodation, which means continued gradual rate hikes toward neutral levels estimated around 1 to 1.5%. Even if Takaichi's government falls or moderates its stimulus plans, the trajectory is toward higher Japanese yields for structural reasons, including demographics, inflation persistence, and the end of deflation that justified zero rates for a generation. This means the repatriation pressure on Japanese capital will persist for years rather than weeks or months, creating a sustained headwind for U.S. Treasury prices and tailwind for U.S. yields that compounds over time. Your 401k isn't directly exposed to Japanese government bonds, but it's almost certainly exposed to the downstream effects of Japanese capital repatriation through multiple channels that aren't obvious to retail investors reviewing quarterly statements. If you own U.S. equities, particularly large-cap technology stocks, you're exposed because Japanese institutions and hedge funds running carry trades don't just buy treasuries with borrowed yen. They buy momentum stocks, particularly the Magnificent Seven tech names that have driven S&P 500 returns for the past 3 years. When carry trades unwind, these are the first assets sold because they're the most liquid and have appreciated the most, generating cash to repay yen loans. The August 2024 carry trade unwind saw exactly this pattern, with Nvidia, Microsoft, Apple, Amazon, Alphabet, Meta, and Tesla selling off sharply as Japanese capital fled U.S. equities. If you own investment-grade corporate bonds, you're exposed because Japanese institutions are major buyers of U.S. corporate debt, and their withdrawal increases borrowing costs for American companies, compressing profit margins and potentially triggering credit downgrades. If you own commercial real estate investment trusts or mortgage-backed securities, you're exposed because higher treasury yields reset the risk-free rate that determines pricing for all other fixed income and drives cap rates for property values. If you own anything denominated in dollars, held in an account that measures returns in dollars, you're exposed to the currency dynamics, where yen strength makes dollar assets less attractive to foreign buyers, reducing demand and prices. The exposure is systemic and pervasive precisely because Japanese capital flows have been foundational to global asset pricing for 30 years. When that foundation shifts, everything built on top of it reprices. The magnitude of potential repricing is difficult to overstate because valuations across asset classes are at or near record extremes that only make sense in the context of the ultra-low rate environment Japanese capital helped create and sustain. The S&P 500 trades at 23 times forward earnings compared to 14 times for international markets, pricing an exceptional growth that requires continued easy financial conditions. The cyclically adjusted price-to-earnings ratio exceeds 40, levels only previously seen at the peak of the dot-com bubble. Corporate debt as a percentage of GDP is at all-time highs, sustainable only with low interest rates that keep debt service manageable. Commercial real estate valuations were set during an era when cap rates compressed to historic lows because treasury yields were suppressed. All of these valuations assume some version of the status quo continues where capital remains abundant and financing stays cheap. The Japanese bond rebellion is announcing that this status quo is ending. When the marginal buyer keeping yields suppressed becomes a marginal seller pushing yields higher, repricing happens not through gradual adjustment, but through violent re-rating as momentum reverses and forced selling cascades through interconnected markets. The velocity of that repricing is typically far faster than the velocity of the initial appreciation because appreciation is driven by willing buyers, while depreciation is driven by forced sellers who must liquidate regardless of price. The political and policy responses will make things worse rather than better because the incentives are completely misaligned. The Bank of Japan faces an impossible choice between intervening to stabilize the bond market through massive purchases that would require reversing years of balance sheet normalization and risk yen depreciation that would reignite inflation, or allowing yields to rise and risking a domestic banking crisis as institutions holding legacy low-yield JGBs face capital impairment. Governor Kazuo Ueda held rates steady at the January 23rd policy meeting after hiking in December, trying to thread the needle between preventing bond market chaos and not abandoning the tightening cycle that inflation control requires. But the market is calling his bluff, recognizing that the BOJ can't simultaneously normalize policy and prevent yields from rising to market clearing levels. Finance Minister Satsuki Katayama urged markets to remain calm, the classic signal that authorities are worried but have no tools to address the underlying problem. Prime Minister Takaichi is barreling towards snap elections promising tax cuts and stimulus that will worsen the fiscal position, betting that voters care more about immediate economic relief than long-term fiscal sustainability. The incentive structure ensures she'll double down rather than moderate because the political costs of fiscal restraint are immediate, while the costs of fiscal profligacy are delayed and diffuse. The United States government faces similar impossible choices. The Treasury needs to sell trillions in new debt over the next few years, while one of its largest buyers is becoming a seller. The Federal Reserve had been expected to cut rates through 2026 to support growth, but rising long-term yields, driven by foreign capital flight, may force the Fed to keep policy tighter than growth conditions would otherwise justify, just to prevent a complete bond market rout. The Trump administration's tariff policies and demands for increased defense spending from allies add fiscal pressure at exactly the wrong moment. Every lever available to policymakers involves trade-offs that make some aspect of the situation worse. The historical template is the 1980s and 90s when Japan's emergence as an economic superpower and major creditor financed American growth and consumption through Treasury purchases, suppressing U.S. yields and enabling the Reagan-era deficits that eventually got brought under control through fiscal reforms in the 90s. That relationship was mutually beneficial for decades. Japanese savers earned positive real returns in dollars while the U.S. government funded operations at below market rates. But the relationship was always asymmetric and reversible. When Japanese demographics shifted, deflation took hold, and domestic yields collapsed to zero, the capital flow reversed from the United States to Japan in the 2000s and 2010s as repatriation began. The current episode is that repatriation entering its terminal phase, where domestic Japanese yields are finally high enough to justify bringing capital home en masse. The historical parallel that should worry American retirement savers is not some emerging market crisis. It's the late 1980s and early 1990s when Japan's own bubble burst after the Plaza Accord strengthened the yen and the Bank of Japan hiked rates to combat asset price inflation. The Nikkei crashed 82% from peak to trough and didn't recover those highs for 33 years. Japanese real estate values fell 70 to 90% in major cities. The entire Japanese banking system became effectively insolvent and required decades of government support to stabilize. The mechanism was capital flow reversal at the peak of a debt-fueled asset price bubble. When foreign capital that had been financing the bubble began flowing out and domestic rates rose, asset prices collapsed because they were only sustainable with continued capital inflows and low financing costs. The United States in 2026 bears uncomfortable similarities. Equity valuations at extremes only justified by ultra-low rates. Corporate and government debt at record levels requiring continued cheap financing. Asset prices from real estate to private equity to crypto inflated by a decade plus of quantitative easing and zero rates. Foreign capital, particularly Japanese capital, integral to maintaining financial conditions. If that capital reverses while debt levels are extreme and valuations stretched, the template is the Japanese bust of the 90s, not the manageable corrections of recent decades. Your 401k exposure isn't theoretical or distant. It's immediate and severe precisely because most retirement accounts are allocated predominantly to U.S. equities and fixed income under the assumption that diversification across asset classes provides protection. But when the shock is systemic, coming from a change in global capital flows that reprices everything simultaneously, traditional diversification fails. Stocks and bonds fall together, as they did in 2022 when the Fed hiked rates. Real estate and credit markets deteriorate in tandem as financing costs rise. International exposure provides limited diversification because the shock originates in global capital markets and transmits everywhere through currency and interest rate channels. The protection retail investors think they have through target date funds that automatically shift toward bonds as retirement approaches becomes a wealth destruction trap when bond markets are the epicenter of the crisis rather than the safe haven. The 60-40 portfolio of 60% stocks, 40% bonds that worked for decades because stocks and bonds were negatively correlated becomes a liability when both sell off simultaneously because the driver is rising yields rather than growth concerns. The 2026 unwind isn't about to start. It already started in January and is accelerating through the exact mechanisms that decades of financial history tell us precede major wealth destruction events. Japanese yields spiked to multi-decade highs. Bond market liquidity evaporated as electronic trading became one-sided selling. Institutional investors begin reporting massive unrealized losses requiring capital raises or asset sales. Government officials start making calming statements about orderly markets, the signal that markets are disorderly and authorities are worried. Global yields start moving in synchrony as the recognition spreads that Japanese capital repatriation will affect every market where that capital has been deployed. The market history of carry trade unwinds is unambiguous. They don't happen gradually. They happen in cascades as deleveraging forces, more deleveraging, and asset sales trigger more asset sales in self-reinforcing spirals that overwhelm policy interventions until valuations fall far enough that fundamental buyers reemerge. The question is never whether unwinds happen. It's whether they happen fast in a matter of weeks or slow in a matter of quarters, and how much wealth gets destroyed in the process. Fast unwinds are more visible and dramatic, but often shorter-lived because they force policy responses and create value opportunities quickly. Slow unwinds are more insidious because each decline feels manageable, but the cumulative effect over months and years destroys more wealth as investors repeatedly buy dips that keep dipping. The Japanese bond rebellion has characteristics of both. The initial spike in yields was fast and dramatic, but the underlying drivers, fiscal expansion under Takaichi, monetary tightening under Ueda, demographics requiring capital repatriation to support aging population, all suggest this is a structural multi-year process rather than a temporary shock. That structural nature is what makes this so dangerous to American retirement accounts. If this were a temporary panic, you could ride it out knowing valuations would recover once calm returned. But if this is the beginning of a multi-year reallocation of global capital away from dollar assets and toward Japanese and other domestic markets as yields normalize after decades of suppression, then riding it out means watching retirement account values decline for years as the reallocation proceeds. The analogy to the 2000s is instructive. From the March 2000 peak to the March 2009 trough, the S&P 500 fell 57%, including two separate bear markets, and took until March 2013 to regain the 2000 peak. An investor who stayed fully allocated to U.S. equities experienced a lost decade with zero nominal returns and significant negative real returns after inflation. Someone retiring in 2000 and drawing from their 401k watched their nest egg shrink for years, regardless of their asset allocation, because both stocks and bonds provided poor returns through that period. The 2026 Japanese bond meltdown is signaling that we may be entering a similar lost decade scenario, where the structural changes in global capital flows create persistent headwinds for dollar assets that overwhelm normal cyclical recovery patterns. When the world's largest creditor nation begins repatriating capital on a sustained basis because domestic yields finally justify it after decades of financial repression, that's not a temporary dislocation, it's a regime change. And regime changes don't get priced in gradually through efficient market adjustment. They get priced in violently through forced selling, margin calls, deleveraging cascades, and the destruction of wealth accumulated during the previous regime. The meltdown is here. The unwind has started. Your 401k is next, not because of some conspiracy or market manipulation, but because retirement account valuations were built on the foundation of Japanese capital suppressing global yields, and that foundation is cracking. The damage won't be sudden enough that everyone recognizes the cause. It will be gradual enough that each decline feels like a normal correction. But the cumulative effect over 2026 and 2027 will be wealth destruction on a scale that makes previous bear markets look containable. And the people managing your retirement accounts have no idea it's coming because they're still operating under the framework that assumes Japanese capital flows remain stable and supportive of U.S. asset prices. That assumption died on January 20th, 2026, when Japan's 40-year yield breached 4% and the bond market voted no confidence in the government's fiscal plans. The repatriation is inevitable. The repricing is mathematical, the wealth destruction is coming, and your 401k is directly in the path.